Hi everybody, Thomas here. Today we're going to be talking about a stock that's been getting a little bit more attention in the stock market lately. Been showing some resilience on the back of pretty favorable earnings, and that's McDonald's. The stock has been down from its high quite a bit. We're going to look and see if that might translate to a good opportunity with a good value proposition for the stock, or whether or not it fits in as one of our proverbial sucker's bets. Let's go ahead and dive straight in. Our chart for McDonald's shows a very long extended upward trend over the past 3 years. From about $180, the stock peaked at the beginning of this summer at nearly $300. And since then, it's dropped about 14% to its current price, right around $257 per share. We can see the stock's upward trend by tracing the 200-week moving average, which is moving up quite nicely. The 20-week moving average, in the meantime, is tracing the stock's drop from its high, which we can see now found support over the last couple of weeks and is showing some upward momentum here with the stock just a little bit below $260. This does fit into our normal idea for what we would consider a bullish level 1 kind of a setup, which does look like it could be attractive. We can also see that the stock's price action over the past few weeks has been picking up momentum. We have a good bullish hammer right here 3 weeks ago, a very strong engulfing candle last week, and this week we have another candle coming up that looks about like this. So overall, there's very bullish indications that seem to indicate the stock is rebounding off of that recent low, a little bit below $250, and is starting to show some positive momentum that could be setting up an opportunity for swing traders and people who like to try to buy the dip to get into the stock at a discount compared to where it peaked earlier this year. The real question then is whether or not the company's fundamentals line up with the stock's price in a way that suggests that it might be a good bargain. So let's go ahead and take a look at those numbers. Free cash flow over the last year has been increasing pretty nicely. We can see an improvement from about $5.8 billion a year ago to almost $6.7 billion as of the most recent earnings announcement, which was just a few weeks ago. We also see an improvement from about $5.7 billion in the last quarter to this current level. So it's gone up almost $1 billion just in the last month. That's a very positive indication, even with a relatively modest free cash flow yield of 3.7%. Cash and liquid assets are a little bit limited, and they have been declining. We see a pattern of decline over both the last 12 months from $2.8 billion to the latest number at about $1.6 billion. Also in the last quarter from about $3.7 billion to $1.6 billion. So cash liquidity has declined by almost $2 billion in the last 3 months. That could be a concern, especially in the light of the company's high levels of debt. We can see that a year ago, debt was about $34.8 billion and increased in the last quarter to a little bit above $35.7 billion. High levels of debt are not necessarily or categorically bad. However, compared to the amount of liquidity, it is a red flag. The real question is whether or not that debt is going to be serviceable and whether or not it represents something that could drag on the company's bottom line. For that analysis, I really like to pay attention to net income and the company's overall, and to use that number as a baseline for measuring the company's overall profitability. Over the last 12 months, net income was about 33% of revenues, which is a good indication that profit margins are very healthy. In the last quarter, in fact, that number also increased to about $35.5 billion. That implies that profitability is very healthy. Along with the increasing cash flow number, it's a strong indication debt service isn't going to be a problem. Also, that the company's dividend of about $6.08 per share is sustainable. All of those are positive things. However, one of the things that I think is a really critical element to pay attention to right now is the value proposition. And we can see that my value analysis is showing that the fair value target for McDonald's is around $234 per share. That's actually a little over $20 per share below the stock's current price, which really means that right now the stock is overvalued by a little under 9%. So that means the stock isn't really a great value right now. Let's go back to our chart and let's revisit some of the things we were looking at in terms of that bullish level 1 pattern where it does look like the stock is showing some positive momentum. Let's take a look and try to evaluate what that opportunity may look like in terms of reward to risk. To identify reward to risk, I like to focus on current support and immediate resistance levels as a benchmark for trying to identify how much near-term upside and downside there could be if the stock moves in one direction or another. With the stock's strong bounce in the last 3 weeks off of support at around $248 per share, the stock is up at around $257 per share, so we definitely see it picking up some bullish momentum, as I've already mentioned. 248 should provide a nice additional level of support, as we can see it's held that for the last month. That begs the question, however, of where the next resistance level is. And there's a lot of ways that you can try to identify next levels of resistance above the stock's current price. I like to go back and try to pay attention to previous pivots and try to identify levels where the stock has previously reversed either to the upside or the downside that are above the stock's current price. These are levels that the market has historically shown it likes to recognize as likely levels of additional resistance. These are levels where the stock could pause its current bullish momentum and possibly drop back again or simply begin to consolidate and move sideways. So it puts a lid on how much potential upside there is. We can see that the stock's really last significant pivot low in this level was earlier this year. Looks like that lines up just about with the $260 level, just a few dollars away from the stock's current price. Now, if the stock can follow its current bullish momentum and push above that $260 level, it does look like there could be additional next support up where the last top end of the consolidation range at the beginning of the year was, which looks like it's a little bit above $270. I'm going to go ahead and call that $272 for the sake of argument. So from here, there's about $3 from the stock's current price to its first likely level of resistance, and about $12 if it can push above that point to its next level of resistance. So if it can break up above 260, that could be an indication that there could be some momentum to the upside and enough room for possibly a good short-term trade. If the stock's momentum stalls, if it hits that $260 level and drops back again, and it drops back below $248, which is a possibility, it'll have about $8 to $10 of downside to that support level around 248. But if it drops, it could find its next level of support, again using previous pivots, at about $235 per share. That means that if we do see it break below $248, there could be about $13 of additional downside if bearish momentum picks up. We do have the 200-week moving average a little bit above that at about 240, and that should provide a level of support before that $235 level that I just identified. Either way, that's about an additional $8 of downside if $248 doesn't hold. In terms of reward to risk then, that means that for McDonald's, there is about $3 of upside to its first level of resistance at around $260, compared to about $9 of downside down to support at about $248, which also breaks down to risk reward level of 1 to 3. That's actually backwards from what we would generally like to see, which is at least 2 to 1. Now, if the stock does push above $260, the argument's going to change, and the profile of the trade and the opportunity is also going to change. In that case, if we see it break above $260, there should be about $12 of upside compared to just about $1 if the stock were to break back below $260. So we literally get a reward to risk ratio in that case of 12 to 1. So the long and short of it is, stock is probably past the point of offering a good signal based on the current bounce off of support. We're going to need to see if it can continue that momentum push up above $260. If it does, there could be some additional upside. As of now, it looks pretty clear, however, that trying to take a new trade in McDonald's would be a sucker's bet. Thanks everybody. Hope this has been useful. If you like this video, please go ahead and subscribe to my videos right here. You can go ahead and do that and get a notification for every new video that I put up on my channel. If you'd like to learn more about my Rebel income system, you can go ahead and check out this video right here. If you'd like to see my trades, you can subscribe to my trading alerts using the link shown in the description for this video. Thanks again. I'm Thomas. Have a great day.